I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview. Awesome. That's great. Marvin, the next one I've got here is the vision and the marketing strategy. You want to elaborate?
Yeah, so I would say, when people ask me about an entrepreneur, one of the things that I always, say about entrepreneurs, the really good entrepreneurs, I think, or really what I would consider classic entrepreneurs, is that most of them have a real vision of what their business should be doing, what problem it's solving. They're convicted about it, right? So there's a clear vision that says, this is where this product place is in the marketplace. This is what it does. This is, they're convicted about it. So they have a clear vision about the products, and then in terms of a group of products or services, how those groups fit together strategically, right? In other words, do they fit together, or are they scattered in terms of the overall vision of the company? Where's the company going? The reason it's important, and then that ties over to, is the marketing strategy a cohesive part of that? In other words, is there a clear strategy associated with implementing that ultimate vision of where the products and collectively the company going, right? Is it able to be evaluated? That's an important value element to a business. When you're saying, does a business itself have value, does that exist, and is it legitimate? Because it's in the world of the stock market, for example, or in the larger markets, one of the most important things that they're looking for, both from a financial point of view and also from a vision point of view, is what's the guidance? What guidance can you give? And so if I'm buying somebody's business and they don't know where it's going, it's very difficult for me to come in and buy the business and take it somewhere, because I don't have the same clear vision yet of your products and your vision for your company in terms of what the pathway should look like. So to the degree that there's a clear marketing strategy that parallels with the vision of the company, that's very valuable, because it saves time, energy, and resources to come in and say, yeah, that's a great strategy. I understand the vision of it. Let's execute at that point in time, as opposed to let's figure out what it is, where we're going with it, and so forth, which is very costly, and really reduces the value of an enterprise if that doesn't exist.
Yeah, I have seen some pretty unique case studies for my sellers. Some of them that have no vision or marketing strategy, documented. It's just, they communicate that in the process of working with potential buyers. And then I've also have some that put together slide decks, and, they've really clearly communicated where they see the brand going post-acquisition, other products, a roadmap, kind of where, the brand is going. And if it were left to me, on a scale of 1 to 5, 5 being a great marketing and vision strategy, I would absolutely put together some 2 or 3 slides on a slide deck. Sure, are a whole lot more meaningful than a couple of anecdotal comments made in a conversation that's not even documented somewhere.
Yeah, and if you go down, just to jump down for a second, but one of the things on the scale, number 12 there, the scalability analysis. It's very difficult to really score high on a scalability analysis if there really isn't a fairly significant vision and marketing strategy in place, right? It's really hard to know how you're going to be able to scale a business if you don't have a clear-cut picture of that vision and what needs to be accomplished. So you're limited in terms of your scalability until you're able to address the kinds of issues like that come about in that strategy. Test it, right? Test out and saying, is this a valid strategy? I know that all of a sudden, if I can put the firewood to it or put the gasoline to it, I know what's going to happen. I know what I can expect. So let's go do it. So again, it goes back to execution of a strategy. If that strategy, in order for it to be understood and be communicated to other people, your strategic relationships in this part of the process, it may be very clear to you, but it may not be clear to them, and therefore you lose time and energy and value in the lost translation. So very critical point.
Absolutely. If there's anyone that's watching, you want to get some examples of a kind of a vision or growth or a marketing strategy, just email me. I'll share some examples for some case studies that are working out pretty well. The description, being the link to me or my email is in the description below. I think that's a piece that's often overlooked. And if you're out there and you're like me, you want to start with something, like not just starting with a blank template. That's super for me. My creative process does not work where I just give me a blank piece of paper to start working. I need iteration and I need inspiration from other sources. It's kind of a copycat artist sort of mentality. There's a whole book series about that, how no art is original, it's all copycat. So that's if you find that of any value or helpful to you, just let me know. I'm sure, Marvin, you probably got some examples if someone is really curious about it.
Yep, absolutely.
Okay, so next we've got financial history validation.
Yeah, and so the next two are really somewhat synonymous, but they're very different, right? And we don't, again, we're living in the world of entrepreneurs, so you hear different terminology like, tax-based, financial statements, or cash-based financial statements, or accrual-based, or GAAP, financial statements. All those kinds of terminology are thrown around in terms of financial statements. For the most part, businesses, until they get to a certain size, entrepreneurial businesses in particular, early stage businesses or businesses, particularly the first couple of years of life normally, those businesses tend to operate on what I consider to be more of a tax return basis. But there is, separated financial statements that are generated internally. Frequently, those are really management reports intended for management, purview, used and shared in that manner. But when you put something, you call it a financial history as a general rule, but you're really saying, the expectation, if I'm an accountant on the outside looking in, or I'm a banker, or I'm an investor, the expectation is that when you give somebody a financial statement, you give them a balance sheet associated with that, or a cash flow statement, you give many of those kinds of things, there's an assumption that you've followed certain levels of rules, and that assumption may not always be correct. In other words, they may come out of, you find that a lot with the people who are in the venture capital place. They're used to dealing with companies who have audited financial statements all the time, who are following a certain, standards associated with audited financials. And so when they go into the entrepreneurial world, they're expecting similar kinds of rules to be being followed with financial statements. That's not always the case with entrepreneurs. Entrepreneurs are a little bit more casual. Their financial statements sometimes don't have the same level of validation associated with them. Shortcuts that are taken there, which are not necessarily intended to misrepresent, but they sometimes do misrepresent because the person on the outside is thinking they're looking at something in Spanish and they're reading German. So it's important that the financial history is validated from the point of view of understanding the rules around how it was sourced, how it was presented, and so forth, and not just accepted at face value. A balance sheet is not a balance sheet in every time, and it wasn't put together the same way. An income statement, I think I've said that to you before, exists between two balance sheets. If you don't have one of the balance sheets, you're violating a core rule about what an income statement really is. So we have to kind of validate what we're communicating in terms of financial statements. And when I review financial statements, that's the first thing I do is I say, am I interpreting them correctly? Can I validate what they're telling me? Is there a misunderstanding about the premises around the financial statement? So that's on the financial history validation, that deals to those issues. The tax returns similarly, but they have a different audience. Tax returns are for the audience of the IRS, for reporting your taxes and so forth. They don't necessarily have to follow the same rules of a financial statement. They have, it's a hybrid form of rule, it's tax law. And sometimes, you can take two companies, same income, same circumstances, and they may report their taxes differently just simply because of the way they chose treatment. So same thing there, you've really got to validate what the tax return is telling you, what the assumptions behind it are, what the sources of it are. Frequently the sources are management information that's been provided to a tax return preparer. He accepts it at face value and goes no further to validate that. He's covered his butt in that regard as far as that's concerned. But in terms of, does it have potential for misstatements or things that are misunderstood? Yeah. So that goes back. There's separated validations, both from a financial history validation and a tax return validation. important parts of the agreement. And we've got to find a roadmap between the financial history and the tax return. We've got to understand how you got from one to the other, and so we can clarify where those adjustments were made, why they were made, and so forth. That's part of the process.
Absolutely critical for those under $5 million deals that are dependent on SBA financing. The lenders are using the tax returns as their underwriting documents, and I see so many people email me, why isn't this one SBA? Why isn't this one an SBA? Why? And it's often because either the growth of the business has been so staggering that the tax return from the prior year doesn't lend itself well to being able to support the current year's, trajectory and next year's trajectory. So just from a financial standpoint, the SBA loan can only finance a certain portion of it. But more often than not, it's because the discrepancy, what I've seen anyways, just in my own humble experience, the discrepancy between a balance sheet and a P&L, the income statement that the entrepreneur is outputting from QuickBooks is often quite different from what is on the tax return. And, most entrepreneurs, tend to try to be aggressive with their tax and their savings. And that sometimes comes back to haunt them because their tax return doesn't show the same level of net income as their P&L does.
And it can be very, costly to them, right? I mean, and I say make that, explanation all the time. And that is sometimes you save $10,000 in taxes and cost yourself $300,000 in business value as a result of those kind of activities. So you do have to understand what you're doing, why you're doing what you're doing, and understanding the trade-off in that regard. And if you're in the position of strategizing to sell a business, in the next 1 to 3 years, then paying attention to your tax returns, sometimes your historical tax returns, and making sure that you've addressed those is a very valuable exercise to go through, because to your point, that's what's looked at. And when an SBA lender is looking at it, if I go down again, just as a quick down to it, one of the things I talk about is a healthy core business test. They don't call it that way, but what they're really saying, is it's conservative. They're historically focused, right? Where's the business been? They're less concerned or less, bought into the idea of where's the business going. The buyer is buying where the business is going, but the SBA and most lenders, are lending against where it's been. And there's that disconnect sometimes that's hard to bridge unless you've got a strategy to bridge that. So you've got to understand sort of the metrics around which an SBA loan is made, an SBA valuation is made. That's a different market or a different target than someone who is more clearly aligned with, I want to buy this business and I want to reach a very aggressive growth multiple in 5 years. They're aggressive to the point, so they're willing to value the business a little bit differently. So, and the audience, dictates to a large degree is what you need to emphasize in those kind of valuation arguments, so to speak.
You said something I wanted to circle back to. It was interesting the way you explained this, and it was that the income statement is it's like the connection point between 2 points in time, which are the balance statements. So if I understood that correctly, let's pretend for a moment we've got a balance statement that's January 1st of 2020 and a balance statement that's February 1st of 2020, and you see the income statement is the activity that's going on in between those 2 points in time. Did I get that right?
That's correct. And so really it's reflected, and really for all practical purposes, an income statement is really a subordinate account to a balance sheet, right? Because it's really the income activity that's taking place. That's the summary of how you made the income that shows up on your income on your balance sheet. So it's basically that explanation from the previous balance sheet. The income change is taking place during that period of time.
I've never thought of it that way, and that makes 100% sense in just a simple explanation.
Yeah, it really is important to understand that, because frequently, and that would come back is that you'll draw a blank and come back and say, well, where is the beginning balance sheet? Because you really can't, you can't have classically an income statement. You can have a summary of expenses, of income and expenses, or cash flow and expenses, and not be tied to balance sheets. It's just really a summary of activity that's much like a checking account register, right? You're recording income or deposits and expenses or checks you wrote from it. But an income statement really is, or a profit and loss statement is really dealing with changes in the balance sheet that may not be reflected, in the same way, because of the accrued expenses that take place or the accrued income that takes place. So that's why when you're dealing with a true income statement, it's really almost always an accrual-based statement between two balance sheets. That's really more accurately what a profit and loss should represent. Otherwise, you're dealing with a cash flow statement, right? And that's what happened to cash between 2 points in time as well, right? And so a complete set of financials normally will include both. They'll include a income statement or P&L and a cash flow statement, because those activities are different. You can have strong cash flow and weak profits, or strong profits and weak cash flow in the same time frame, and it's just because of the way they're measured. And if you don't understand the one, that's why working capital, going to the next one, capital structure is important, and you have to understand those elements associated with it, because if you can be doing, in a lot of businesses, particularly fast-growing Amazon businesses in particular, any fast-growing e-commerce business, they can make a ton of money, and it's all in inventory. Their cash flow is a problem, right? So if they're growing, they're building inventory or tying up inventory in the channel and so forth, and maybe they're taking cash out of the business because they're not really measuring that element to it. And the first thing you know, they don't have the cash, the working capital to support the business. So capital structure is really addressing the issue of how your debt and equity position is on a balance sheet and what the requirements of that are going forward. So if I go forward 6 months, what's going to happen to my cash in that time frame, right? And do I have sufficient working capital to support that? If not, do I have debt, places I can go to borrow to support the working capital needs if I don't have the equity in the business to support it? You don't want to know that, when it's too late to do anything about it. And many businesses grow quickly and get into that place. In the old banking term, it was called a case of the shorts, right? Business is doing great, we just don't have any money. We have a case of the shorts in that scenario. So yeah. Capital structure analysis is really important, not only for the business as how it's existed, if you're evaluating it, but if you're buying a business that's growing fast, you have to understand the capital structure needs that you're going to have, which may be different than the business has needed in the past.
Very good. What should entrepreneurs and buyers be looking at with regards to their business plan?
So if I'm a buyer or working with a buyer, right? It ties a little bit, and obviously the vision and marketing strategy frequently is part of that business plan, a portion of that business plan. I'm looking there for authenticity, and most more sophisticated investors or bankers are looking for that is, do they know, what is their plan, right? Where are they going? Because it incorporates the things that we're talking about. It incorporates the marketing strategy. It incorporates the capital structure that you need. It incorporates, the more structured or more deep financial plans. You may have not only income statement P&Ls going forward, cash flow statements going forward, but also balance sheets, right? Because they're looking at what's my balance sheet at the end of year one going to look like? Do I have sufficient working capital to continue to support the business? So the business plan, depending on how complex you make it, but most importantly is, does one exist? Does the driver of the business have a plan? And if he does, what does it look like? And is he following it, in that process? And has it got obvious weaknesses associated with it? Most entrepreneurs don't have a very good business plan or absent one completely. One of the things that I like to introduce to a buyer or a new entrepreneur or someone who's acquiring a business is the concept of an evolutionary business plan. And what that says basically is that we plan forward and we say, what do we know for sure? Let's project it. We know if we have a rent figure, for example, and it's a 5-year lease, we know what our rent's going to be for the next 5 years. So we can plan all of those things that we know absolutely, as one part of the plan. Then we put levels of expectations based upon the probability, high probability or low probability. Am I likely to have this level? This is a pretty, reasonable level of expectation of growth. If so, what's the inventory level required for that? And if my plan evolves differently, evaluating it either monthly or quarterly, then I adjust my plan by those evolutionary changes. So an evolutionary plan says I don't set it and forget it. I don't get a 5-year plan and go look at it every 3 or 4 months. My evolutionary plan is that's really my working document that says, let's look at this. What are my assumptions? What changes do we need to make because of a difference in what the reality is currently?
Got it. That's good. I'm a big fan of Building My Story Brand by Donald Moore. It's not a full-on business plan, but it's a good. It kind of goes back to the branding aspect of things, but it's a good starting point, I think, too, for business planning purposes. Is kind of understanding the core of like what's the brand about, what's it for, and then getting into something a little bit more, a little bit deeper there. Marvin, do you have any suggestions or templates? Like where would you send an entrepreneur to if he doesn't have a business plan? Where can he start out without having to like start from scratch on a blank piece of paper?
I've got a couple of templates. I mean, there's a core one. You can go to SBA.gov and they've got a business plan template you can pull down from there. There's a lot of those out there. The only thing that I say about them is that I think a good plan has worked through a number of different scenarios, so that you said, okay, and I like the idea of saying, absolute as much certainty. I know for sure I'm going to have these expenses, and minimally I know for sure I'm going to have this level of revenue and what my expectation is there. So I like to build it first from sort of a financial, point of view, and then look at what the elements to support that financial plan look like. So what's the labor look like? What's the advertising look like? All of those components that really support it, and do they tie in? Does it make sense? For example, if you're coming and buying a business and it's growing, we do what we call a trend indicated growth plan. And we take the trends and say, okay, here's the trend. You're growing at 10%, your expenses are going up at 5%, whatever they are, that's what our trends are telling us. And then we come sometime and we go to a banker and say, but we're going to grow this thing at 20%. But we have no real justification for why it's going to change away from the trends, right? And so, but if we've shown history of where we spend X amount of dollars in advertising, we're going to grow at some multiple of that, and we're going to increase our ad spend, we have a reasonable expectation of increasing our revenue. That's the tie-in. The assumption is we're going to increase ad spend to X. As a result, our expectation is revenues to grow at Y. So again, it's important to stay focused on the plans, financial plans, because all the activities feed them. And that keeps you on track from my point of view.
I have found the most entrepreneurs that I've bumped into. I've been a member of Entrepreneurs Organization, who uses Scaling Up, Vern Harnish's book. A lot of really good templates in here. There's strategies and stuff for your vision and that sort of stuff in here. But by far, the number one recommendation I get from folks that have built multi-million-dollar businesses is Traction by Gino Wickman. This is the number one book with lots of very easily digestible material for people to be able to kind of implement some of this stuff, which honestly, all the businesses I've sold this year, none of them have done any of this. If they had, it would have been that much more, that much easier for them to get probably the value they're looking for. Because even the lower middle market range that I play in, a lot of my listings are in the $1 million to $10 million EBITDA range, and they're being listed for, $5 million to, I've got a listing $105 million, and even those don't have business plans, don't have vision and strategies documented. Couple of them did, and have gotten some phenomenal results from it. But those of you watching, if you haven't gone through Traction, this is the Gino Wickman. This is the number one. I've seen people come to my events and literally after 3 months tell me that their revenue's up 30%, their profits up 50%, just by implementing some strategies from those books.
Yeah, I think that's good advice all the way around from that standpoint. Moving down that pathway a little bit and tying over to that.
Thanks for watching. If you like this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.